Good afternoon. This is Kathy Neifeld, one of the four partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to week 3 of the 2020 Agency One annual, and we hope for this year only, virtual advisor conference. Thank you for joining us. For those of you who have joined us over the past 2 weeks, we hope you found value from the speakers and content that was shared. Throughout October, Agency One is hosting over 20 one-hour sessions on a variety of topics, including practice management, tax policy, the economy, estate planning with high net worth clients, sales opportunities, some that are general and others that highlight a specific product, charitable planning opportunities, how you can become a shareholder in an agent-owned reinsurance company, opportunities for wealth managers that are looking for a fee-based alternative to the more traditional life insurance sales process, and much, much more. We have featured nationally recognized speakers, including estate planning attorneys Ed Wren from Withers Bergman and David York from York, Howell & Guyman, New York Times best-selling authors and inspirational speakers Ben Nemtin, Tim Arnold from StoryBrand, and Kim Lear from Inlay Insights, economic and legislative updates, product specialists, sales ideas, and our very own Gonzalo Garcia, just to name a few. All of the sessions that have taken place so far have been recorded and can be accessed by you through the attendee hub. Hopefully, many of you that are joining us today have participated in the conference over the last 2 weeks. So I am going to abbreviate the history of Agency One and how we got to where we are today. For those of you that have heard this before, please indulge me. We have a lot of new advisors joining us as the upcoming session has generated a significant amount of interest. The principals of Agency One have been working together for more than 30 years, always in the life insurance brokerage space. We love what we do, and we love working with the advisors that are part of our Agency One 100 group. One of the tenets or basic value propositions that is central to our Agency One offering is providing educational content, networking opportunities, and idea sharing with our advisors. We hope we are succeeding in providing this to you in this virtual format. For those of you who have attended our conferences in the past, thank you for being with us today. For those of you who do not know us, we hope that this experience will give you some takeaways that will help you grow personally and professionally, and that it will expose you to the culture, capabilities, and professionalism of the Agency One organization and family. We have a terrific schedule for the remainder of the week and next week, and we hope that you will be able to attend all of the sessions. Once again, the entire meeting is being hosted through an attendee hub where you have access to the entire agenda, live streams, virtual meeting rooms, and a virtual exhibit hall for our insurance company partners. We hope that you visited that exhibit hall earlier today at 11 o'clock. Now, just a few housekeeping items. All attendees will be on mute. You can submit questions through the chat function in the attendee hub. This session is being recorded, and a link to the recording will be made available after the session. And please do not forget to complete the session survey after the session. Again, I would like to thank you all for being here today, and I would also like to thank Nationwide for sponsoring this session. Today we are going to discuss planning, the pandemic, and linked benefits. We have 2 nationally recognized experts in the field that will be joining us, along with our very own Gonzalo Garcia. In no particular order, please allow me to introduce Shawn Britt, Director of Long-Term Initiatives with the Advanced Consulting Group with Nationwide, and Kim Natovitz, a phenomenal advisor with TriBridge Partners and also a very good friend of Agency One. Shawn has been engaged in the life insurance and long-term care industry for over 25 years. She joined Nationwide in 2000 and has been a member of Nationwide's advanced sales team since 2005. Shawn has been a major influence in the development and promotion of Nationwide's suite of long-term care products. Shawn is also a frequently published author of white papers and articles on on long-term care for Nationwide as well as the insurance industry. She has been widely published and interviewed regarding long-term care for numerous trade publications and nationwide media that include CLTC Quarterly Digest, The National Underwriter, Financial Advisor, Center for Long-Term Care Reform, The Wall Street Journal, CBS New Money Watch, Market Watch Radio, and Life Health Pro, just to name a few. She is also a frequent presenter and keynote speaker, and she is also a frequent presenter and keynote speaker at numerous industry events and conferences. Shawn, your qualifications obviously speak for themselves. Let me now introduce Kim Natovitz. Kim has over 25 years of industry experience, including several years working for insurance companies. For the last 2 decades, high net worth individuals and strategic advisors have asked Kim to work in partnership with them to develop customized insurance solutions to mitigate risk and create tax-favored benefits for executives and employers. Kim's work is centered in planning for the unexpected, utilizing insurance products that provide liquidity at disability or death, but with a special emphasis in estate planning and retiree health care. By asking the right questions to facilitate meaningful conversations, Kim assists advisors and clients in looking at the big picture instead of focusing on just one issue in order to create comprehensive solutions. Kim has been recognized by Bethesda Magazine, Washingtonian Magazine, and Northern Virginia Magazine by her peers as a go-to insurance advisor. So the experts are eager to get started. And with that, I am going to turn this over to my partner and the individual who oversees advanced markets at Agency One, Gonzalo Garcia. Gonzalo, take it away.
Thank you, Kathy. I am honored to be here with Kim and Shawn. Shawn, can I ask you to unshare your screen for me, please, so we can see both you and Kim. We have been planning this meeting for a long time, and I was just absolutely thrilled to get this subject on the docket because there is so much to talk about right now in the long-term care environment. And I can't, I'm just honored to be here with the two of you who are just such great experts in this field. So, and I really want to make this conversational. I also want to encourage the people on the live stream to ask questions. So I will be monitoring the questions from my phone. So I'll be able to read them out as we go along. But let's kind of get started, Kim, with you. As Kathy said, you've been doing this for 20 years. You've been advising clients. You were a big fan of traditional long-term care in the past. What changed and why are you now predominantly selling linked benefit products?
That's a great question, Gonzalo. So while the traditional products I've really liked and they've provided a tremendous amount of leverage, a lot has changed in the industry and with regard to the awareness of planning for long-term care. So the industry, as we saw when they first began to price long-term care insurance, we saw a lot of flaws with regard to some of the projections. And we also found that a lot of consumers, especially high net worth clients who could self-insure to a certain extent, really didn't like the fact that it was a use it or lose it product. And as we really look at changing family structures and applications around long-term care planning, having the hybrid product where we could have a death benefit also solved, a lot of issues. So we've been using long-term care in, prenups and postnups. And when we have the ability to, have the money go back to the family if the long-term care is never needed, that's created a lot of planning opportunities. Or for someone who wanted to have their adult children receive, something if they never needed the long-term care. Mm-hmm. So there have been a number of reasons, and with the explosion of the awareness of long-term care, the hybrid products really allow you much more planning flexibility. and premium guarantees as well.
Yeah, those are great points, and we're going to unpack some of that as we go along. But so Shawn, from your vantage point and from a manufacturer product development standpoint, I mean, the transition to hybrid products has been, I wouldn't say super quickly, so it didn't happen kind of all at once, but clearly, I mean, if you look at all the LIMR numbers and all the statistics on sales, traditional long-term care sales have gone down over time, but the hybrid products have just really taken over. I mean, can you give a little bit of perspective on kind of how the market evolved? Because it kind of fits right into what Kim just talked about.
Yeah, it took a little time. You know, if you look at the statistics, you can see over the last 10 years, the linked benefit products have really taken over the marketplace. And I think, you know, in the beginning, they were a great idea, but they were truly for the high net worth client, or at least for the affluent client, because so many of them were based in a single premium. And then the industry kept getting the requests. We love the idea of these products. We love the guarantees that come with them. And we love the fact that they have a look and feel of a traditional policy where you have a different choice of benefit periods and you can add inflation, but my client can't afford it. They don't have $100,000 to just move into the product. So the insurance companies listened. And of course, with interest rates going down, the insurance companies also like the idea of spreading out the payment. So today, now, because the opportunity to buy them has increased with the expansion of the premium mode. So today it's not just, a single premium, but you can use a 5-pay, a 10-pay, a pay to 65. There's even a couple of companies that'll go pay to age 100.
Yeah.
So the opportunities have expanded, which opened up the market.
Yeah, and so they've really kind of, they've evolved, as you said, over time because of market demands. I want to take a quick little shift here and talk about COVID in the last 6 or 8 months. And Shawn, let's start with you because, again, from a manufacturing standpoint, you guys have amazing product. How are sales? What are people talking about? And why is long-term care so important in today's COVID environment?
Well, for us, for Nationwide, our Care Matters product has been doing extremely well in this environment. And there's a couple of reasons. One, when you see what's been going on in the facilities, people are scared and they want options that allow them flexibility. And, not to do a product push here, but it's important to note that we are a cash indemnity policy. And when you have cash, there's no restrictions on how you use the money. So if all of a sudden you have a pandemic now or in the future, you've got the opportunity to pivot your care plan on a dime, literally figure out how you want to do it, even if it is some crazy alternative, but you can still use your money to do whatever it needs you need to do to stay safe. So the benefit mode has been attractive because people realize, I'm going to have more flexibility. And then two, even the underwriting, and it's not just our product, it's all of the linked benefit products are set up with simplified underwriting, or some people call it streamlined underwriting. And what that allows is literally, if you have a client who does not want to see a single human being, and at my age, we actually have friends who have not come out of the house yet. Yeah. So if you do not want to see a single human being, a linked benefit policy can be purchased. As long as you have a way to sign that application, which most people have an iPhone or a computer to do an electronic signature. I've even heard of a couple of cases where the clients didn't, the advisor slipped them under the door. They signed them and slipped them back under the door, but everything was done by telephone. Because the underwriting does not need, the client does not need to see a single human being. There's no fluids, there's no paramed. It's all done over the phone. So this product is something that can be easily planned for. Long-term care can be planned for with linked benefit policies in this type of environment.
Yeah, and sales are thriving. I mean, you know, Kim, I'm going to go a little bit off script here and maybe ask a question because you brought up an interesting point, Shawn, is that, you know, a lot of people are dying in nursing homes, and more people want to be cared for at home, and that presents a ton of challenges. So, you know, Kim, as you're advising clients and talking about different types of products, and again, not to make any specific product plugs here, but the issue of home health care or home care versus in a nursing home. I mean, how are you guiding clients in that conversation? Because that is so relevant to the COVID period that we're dealing with right now.
Well, I think COVID has really just, first of all, people have recognized they're not immortal, and that, you know, something can happen very quickly, and they may all of a sudden be in a position that they need care, and regardless of age from that standpoint. I think the other option also is, you know, control, and the cash benefit hybrid contracts, you know, really give people more flexibility at the time of claim. So we have a client, as an example, who lives in New York City, and he had a stroke. His wife is working from home. She's teaching in a charter school, and he needs care all day long. Well, you know, they had to make a tough decision of not to have their aide come, because their aide literally took, you know, a subway and a bus, and they were really concerned with regard to COVID. When they had the ability to have, you know, either an adult, their adult son who had moved home, or another person in their building, and having the ability to, you know, mitigate risk and have control is huge. And the other thing I really like about, you know, the cash benefit hybrid products is it's not just the home healthcare labor, it's also the care management. And so you can make decisions in real time and bring in allied professionals that can really help the experience, because the care managers speak the same language, and they can get things done that families can't get done. And so, you know, having that in part of your plan is essential, I think, as well.
Yeah, yeah, it really is. Shawn, you want to elaborate on that a little bit again from kind of Nationwide's perspective or a carrier's perspective relative to, you know, what you're seeing in nursing homes and what you're seeing in home care? Any anecdotes or any questions there? Any comments there?
Yeah, well, I mean, one thing is, you know, there was a recent article out there about one of the major long-term care insurance carriers who no longer sells new business, but still is implementing a lot of claims because they were a big carrier 20 years ago. And they saw a massive decrease in claims when COVID hit. They also were a reimbursement policy. And when the clients actually called and, you know, asking about going on claim, finding out that they had to use a professional service, and they're virtually, they were all saying, but we don't want that revolving door of people. Yeah. Now that same company is ready for an onslaught of the claims to come in after the fact, but there will also have people who will die before the claim is ever filed. When you have a cash plan, you're not dealing with those issues. Again, like Kim said, you have total control over your care. We at Nationwide use the phrase, you know, family care should be a choice, but it could become a necessity. And that's where we are right now with COVID is, you know, in some families, it's expected that family take care of family. And we give you a way with a cash benefit. We feel we give you a way to compensate your family. And think about this too. If you're taking care of your mom and your mom just offers, you know, hands you cash, you're like, Mom, I can't take money. But if an insurance company is giving your mother benefits for that purpose, the child doesn't feel so guilty. And that child may really need that supplement because they've cut down their own work hours, etc. So we feel like we've provided, as a carrier, our goal is to provide the ultimate choice and flexibility for families.
Yeah, let's unpack that again. And I apologize, I'm going a little bit off script because we had a number of questions prepared and so on. But you bring up a really great point here, and that is some of the sacrifices that adult children are making to care for their aging parents. And it's cutting back work time. It's when they cut back work time, they cut 401k contributions and potentially sacrificing a lot of other things. We're also starting to see massive incidences in depression, alcoholism, and other issues in those adult children that are having the stress of managing their own children and their parents and so on. So, I mean, you know, the fact that the parents are able to provide some sort of cash compensation to those adult children for lost time at work, lost 401k contributions, and other things that they're dealing with on their own right is really important. I mean, that's really, really meaningful.
Yeah, and it's guilt-free cash. That's the difference.
That's a great point.
Guilt-free cash.
Yeah.
I'm sorry,
Kim,
Kim,
you
I
were going to
didn't
jump
mean to
in here?
interrupt.
Not.
Well, I was going to also say that when you have that cash, you can really solve for what is needed. So in one of my families I'm working with, you know, there are some people that have less work due to COVID. There are people who have more work due to COVID. So having an adult family living with them and caregiving, you know, with one particular family, we said, well, what you really need is some help with meals and so on from there. So when you have a cash benefit contract, as an example, almost every caterer now is doing drop off. And so we've worked with some families where, you know, the labor isn't the issue, but here are some of the other things that they need. So you can just make the best decisions in real time. And, you know, traditional policies just don't enable that. There isn't that same flexibility from that standpoint. So I think that's hugely meaningful.
Yeah. Well, let's kind of begin to unpack the issue of guiding clients, and Kim or Shawn. Well, let's start with Kim. You know, as you interface with clients and are giving them counsel around what they should be looking for relative to product and planning, right? How do you feel the best way to approach the long-term care conversation is with clients?
Well, I think that, you know, for a lot of clients, where I start the conversation is who knows what kind of care you would want and how it would be facilitated. So everybody has an estate plan that says, if I die, this is the funeral, this, that, and the other. But I think we need that same plan for living. And so starting that conversation around, you know, if your health changes, you know, who has the information in order to make decisions on your behalf. And often people say, well, I have a healthcare agent. And I say, you know what, that's great that you have a healthcare agent. Do they have any experience making these decisions? And they're like, no. Do they even know? No, and so on from there. And so we often begin talking about, well, you know, you have a financial advisor, you have someone who prepared your documents and so on from there. You probably ought to think about a professional who's going to give you some guidance. You know, when your adult children are in California and you're here, as I always say, when the other orthopedic shoe drops, what are you going to do? And from there, we begin talking about, okay, so here is what some of your preferences are. And now we need to talk about, you know, how would care be paid for? And that usually is how we begin the discussion from that standpoint.
Right. Shawn, you in our prep for this, you had a really interesting comment, and you said long-term care is not a place, it is an event that needs to be planned for. Can you walk us through that and elaborate? Because I think that's brilliant.
Yes, if you know, when you use the words long-term care with your client, the first thing that comes into their mind, at least a lot of them, is nursing home. So they're already on the defense. Maybe they think assisted living, but the point is they're thinking of a place they don't want to go. and you want to talk to them about going to that. That's how they see it. So you've got to twist that thought right out of their head from the very beginning and get them to understand we're talking about an event, not a place. So this isn't, would you ever dream of not planning for retirement? Of course not. That's the number one thing we plan for. And long-term care is part of the retirement event. It's a sub-event in your retirement plan. And the costs, if they aren't planned for, could totally unravel your retirement and your legacy planning. So if we think of it as an event, and it's an event, if we plan for the event, it can be what we envision it, or at least it can start out that way. Sometimes, all good plans don't end as we wish, as we know, but you have to make adjustments. But if we think about, as Kim said, we need to put this down on paper, just like we put down other things on paper for our family. You have that will, like Kim said. Why, with instructions, you should have the same instructions for here, kids. This is what if something happens, here's where I'd love to go. My mother told me where she wanted to go, which she referred to as the cruise ship on land. She liked, my parents loved cruises. She loved all the activities, and she wanted to go to a place that was like being on a cruise ship. Meaning find me a facility. I don't want to stay, when your father's gone, I don't want to be at home. And she was clear she didn't want to live with me. So I don't know if that's good or bad, but the point is she was a social being. She knew what she wanted. She made it very clear to me. And that's so helpful when you make those plans known to your children, but you also have to fund that plan.
Yeah.
So that's sort of how you can get them to, Kim mentioned earlier, what is it that you would like? You need to ask them that. And I always tell people, don't think about things like the obvious. Tell me without any restrictions, with no boundaries, what would you like? They may give you, I've heard some crazy stories, but that's okay. Because that'll tell you if they're giving you crazy stories, they probably need a cash plan because they need that flexibility, but it helps guide you to the type of policy, the benefit mode. And it also can tell you, okay, that's a great idea. So put that number one on your list to the kids. Now, what if that can't, what's our backup plan? And now all of a sudden we've kind of almost made it fun. I don't know if you could call thinking about long-term care fun, but you want to try to make it so that it's not this dire, horrible, going to prison type conversation, but rather planning for, a nice end to your existence.
Yeah, Kim, from a client-facing advisory standpoint, I know, Shawn, you talk to clients and advisors all the time as well, but Kim, you're in the trenches every day talking about this and have been for 20 plus years. So curious as to kind of your elaboration or perspective on what Shawn just said.
Well, and I think you have to have the conversation, because the conversation I've had with a lot of my clients is their biggest regret is they had no idea what their parents wanted. And so they made decisions for them, and they have a tremendous amount of guilt. And so often I start the conversation with, no one's going to be able to honor your wishes if they don't know what they are. And so that's a great way to begin the conversation about planning. And then, to really delve into talking about, the funding. And, people always talk about, well, I have enough assets. I have enough assets. It's not assets, it's income, which is materially different from assets. And when we begin to think about, can your portfolio throw off another $12,000, $15,000 a month, just turning on that spigot? For most people, the answer is no. So it's really not the assets, it's the income. And that's the other conversation that we really have to have with clients.
Right. Well, let's go there, because that was kind of the next natural path, and how to determine how much coverage to purchase, and in what amount and benefit period, and what other bells and whistles are you putting on these, and Shawn, you had prepared a number, in our prep, you had a number of ideas. I think you may even have some visuals for us on this, but I could be wrong on the slides. But kind of let's attack and begin to unpack that part of it. It's determining how much to buy and so on.
Right. So as far as how much to buy, first of all, there's nothing too little, other than what the company, you have to meet the company minimum. But I like to start with 4 years as your guidepost. Now, the reason for that is this: you see these statistics out there, of which, and they're all over the place, from 2 years, 3 years, but those are including all the people who died quickly. We don't insure for the short term, we insure for the long term. If you knew you were going to die in 3 or 6 months after having a long-term care event, I doubt you would buy insurance. I wouldn't. Most people wouldn't. So now what we want to do is start with people who survived the first year. And if they survive the first year, the average claim will be 4 years. So I like to use 4 years as my starting point. Now, if they can't afford 4 years, then you get them 3. Or you get them 4 years, but with less money. Because remember, we're insuring for the shortfall, not the actual cost of care. So as Kim said, we're paying for it with income, and we may have some excess income that could be used. So we need to insure for the shortfall. And then women will be on claim longer than men statistically. And so if you have a couple who may have some budget constraints, and as I see, nobody's a mind reader here, but if she's at least as healthy as him and the same age or younger, you might want to consider putting a little more of the money into her, because she's more likely to use the policy and more likely to be on claim longer. So these are just some general guidelines that you can use, but I like to start with 4 years and then go up or down based on budgets, based on gender of the client, based on, the factors of their portfolios.
Right. And Kim, kind of same question in terms of just, again, from a practitioner standpoint, how are you advising clients on that?
Well, I think, first of all, like Shawn, looking at, and this is where a little humor comes in, which is, I always tell people, this is the one time in your life you want to plan on being average. So let's talk about averages here. We all know someone who knows someone who's been in a nursing home for a decade and so on from there. But we're really planning for, some of the averages here. And then we take a look at, income. And again, it's, if we went on claim in our, 60, 70, 80, and we had this additional amount of expense, how much of this are you comfortable saying I can withstand? And then the question is, how much of that comes into in terms of legacy? So I have some clients who, they may feel comfortable self-insuring for more risk, and others who'll feel less comfortable because it's really important to them to leave assets to their alma mater or their church or to their children and so on from there. To Shawn's point, some long-term care insurance is better than none. Because my experience has been, whether somebody has $3,000 a month or $9,000 a month, having long-term care insurance, there's a domino effect in getting someone else involved, helping the family, and better decisions and more support made, along the way. And then for some of our clients, looking at repositioning an existing product could be appropriate. They may have a life insurance policy that has a significant amount of cash value. And from a death benefit standpoint, they don't necessarily need the death benefit. And so, you know, we can do a tax-free exchange into a hybrid product. Or if we have an annuity, as an example, a non-qualified annuity, and someone doesn't plan to annuitize, you know, we might take that annuity and do a period certain annuity and feed that into, you know, a hybrid product over a period of time. But it's all about what the client's, you know, goals are. Is this really to have the best healthcare money can buy? Is it asset preservation for someone else, or some of both? And no two situations are alike.
Right, right. You touched on something, Kim, about having previous coverage, and this was one of the questions we wanted to talk about today. Was when you encounter people, you know, the tradition. You've sold a lot of traditional long-term care policies in your career. A lot of them are experiencing massive rate increases and so on, and all sorts of other things going on in the marketplace. What is driving those rate increases, and how are you dealing with clients to either reposition their portfolio or give them some outs or some other options relative to kind of dealing with their long-term care needs?
Sure, sure. So first of all, the traditional long-term care policies, I think that talking to anybody who owns a traditional long-term care and offering to review the rate increases with them, there isn't a better marketing opportunity out there. So I think, you know, the carriers obviously are sending options where you can reduce benefits, or you could take less inflation or add co-insurance as an example. What I find on average is that it isn't always the option that makes sense for the client. And I can't tell you how much goodwill I've created with, you know, estate planning attorneys, CPAs, and so on from there. So never turn down the opportunity to review a long-term care policy with a rate increase. Now, a lot of the rate increases are stemming from the fact that, you know, 20 years ago, clients bought policies with a 5% compound inflation rider. And obviously in this low interest rate environment, you know, increasing benefits year after year, 5% compounded, is difficult to do without increasing premiums. So I'll give you an example. I'm going to share my screen, but this is something that we actually worked on with the client, where we said, well, you know, what should we do with this existing policy? And is there a way to deal with this policy, keeping what is working, but maybe repositioning some of what we're doing? So this is a client who had bought a Mass Mutual long-term care policy, an indemnity rider, and the benefits, as you see, is benefit from the 5% compound inflation. This is the current premium, $46.69, okay? No death benefit in this contract. And he is not deducting this premium, so there is no tax benefit from there. So we know Mass Mutual has filed, as many of the other carriers have, for 70 to 80% rate increases. So what we did was we said, well, we went back to Mass and we said, well, could we freeze our current benefit? Could we keep the unlimited benefit period? And what would the premium look like if we did that? And so we found that we could. And so then we said, okay, the client had a life insurance policy that had a lot of cash value in it, more death benefit than they needed. So we said, well, what if we were to take some of that basis out and look at buying a hybrid contract where we would guarantee what the benefits would be in the future, and we potentially kept the Mass Mutual in force, but without the inflation. And so as an example, we said, when this client is 80, if we had 10,000 a month from Mass Mutual, and if we took the nationwide with the 3% compound inflation, we'd have $22,000 a month of benefit. So we would have $32,000 a month of benefit if we potentially took the 3%. And another option is we could also say we wanted to take the 5% compound inflation. And we would again have about here, we would have $38,000 of death benefit. So we're almost matching what the client has here. And what I said to this client is, I think over the next 20 years, 30 years or 40 years, it's highly unlikely that you're going to keep the 5% compound inflation, because the cost of that is just going to continue to rise. So the likelihood is you would probably adjust at some point in time. The carrier is likely to offer a 3% compound inflation rider. So you will have probably as much benefit in the future. But with this single premium, we've guaranteed these increases. We have this death benefit. And if we did get some additional premium increases from Mass Mutual, we also have the ability to say, we're going to drop this back to a 6-year benefit, because the client didn't buy an unlimited benefit period because he wanted an unlimited benefit period. He bought an unlimited benefit period because when he purchased the contract, there was almost no difference between 6 years and unlimited. So he just went ahead and bought it. So I think there are a lot of opportunities to look at potentially keeping some benefit and perhaps using other funds as an example in order to create some additional benefit and have more flexibility at the time of claim and a better idea of what your premium outlay and your benefits are going to look like. So I think that's, one thing we're going to see more of.
Yeah, and what you're doing there is taking a lot of the uncertainty around some of these premium increases on a going forward basis. And you're also, I think what I saw there is you really freed up some cash flow. I mean, you not only curtailed future massive increases, but you lowered the existing premium on the policy and then just really repositioned another asset to buy that single premium Care Matters contract. Right?
Exactly. And in general, clients would prefer to minimize expenses on a post-retirement basis.
Yeah.
So they like the psychology, the aspect of, I don't have these ongoing expenses as well.
Right. Shawn, you talk a fair amount to high net worth clients or advisors talking to high net worth clients, and what differentiate for us, like at what point, or maybe explain to us, at what point do people begin to say, I've got plenty of money, I don't need long-term care insurance, or how are you positioning this relative to high net worth or even uber ultra high net worth clients in the conversation?
Well, one of the things when you have a conversation is you have to tailor it to your client's wealth, because how you talk to a middle class family is going to be different than how you talk to an affluent family, and it'll be even different yet to a high net worth. And in fact, that ultra high net worth are the people that some advisors don't even bother talking to, when they're probably they're at least as equal to everybody else. And I'll show you why. I'm going to pull up some slides here. And hold on, let me get these. So let's first talk about the affluent client. So
Yep.
I'm talking, when I say affluent client, I'm talking about someone who has a lot of money, but they are not in an estate tax liability situation. And as we know, because the ceiling for that is so high now, you can have some very wealthy people who still don't have an estate tax problem. And they're going to tell you that, I don't need to buy long-term care coverage. I'm just going to self-insure. And which, of course, I don't even like the phrase self-insuring, because you're really self-funding. You can't immediately leverage your own money. So you're self-funding. But let's look, I've always said to these people, just take a yellow pad, draw a line down the middle and say, let's compare your idea of self-insuring with my idea of self-assuring, because self-insuring is really unsuring, and we want to be assured of what we're doing. So if we do it your way, and I'm not saying that's a bad idea, but if we do it your way, and let's say we set aside $100,000 and we put it in an account that won't be affected by the market, which means right now it's not going to earn much, but it's always be there, and it's cash. So if you ever need care, you're going to have the flexibility of going and getting your own cash and paying for care. But the problem is when that money runs out, you have to go back to your income and assets. And do you have the type of income that's going to pay for the type of care you want? I mean, you're not going to go to an average place. You're going to go to one of the best places in town that costs a whole lot more than the average cost of care that you're reading about in the Sunday paper. So now we have to think about also, where's your portfolio at such a time you'd have to go get the money? What if it was back in March, this year in COVID, back in March when the market went down 40%? Do you really want to be pulling out money from an account already down 40%? Because that money is going to suffer a double loss, because you're never going to grow it back and you're never going to grow it forward. So let's look at a way to self-assure. We're going to take the same $100,000, but instead of putting it in a bank account to grow slowly, we're going to put it in a linked benefit policy. And if you ever need long-term care, the first $100,000 the insurance company pays is your $100,000. But I'm going to show you a cash solution so that you have that same flexibility of having cash with no bills and receipts to turn in and no restrictions on how you use the money. But here's the part. When you do the self-assure plan that I'm showing, you have a stop loss. So the thing is, use investment language, structure the whole conversation around the portfolio and their investment. So again, if you need more long-term care after that $100,000, you have a stop loss because the insurance company is now going to pay the next $491,000. What we've done is insure your portfolio against having to touch it in an inopportune time. And we've done it with an investment that will never lose money, because the worst case scenario is, in this particular age person, if you never need the money, your estate gets $197,000, which is more than your $100,000 would have grown in that CD or savings account at the bank. And if you do need it, you're only out $100,000 because the additional money is going to come through that stop loss through the insurance company. So the idea is, I want to create a dedicated stream of income off to the side, not tied to the market, that's going to pay for long-term care needs. So now we've shown them how we've talked about insuring the portfolio, not the person. So we've taken them out of it. And we've talked about a stop loss. And we've talked about their money is secure. And if they don't need it, the money, it's going to be at least the $100,000, or depending on their age, there'll be some leverage. So by doing it this way, we're not talking about insuring them, but rather making it all about the portfolio and protecting their assets against having to go get them in a down market. Or again, it's really about, and you don't want to have to rely on income at an inopportune time either. So that would be for your affluent client. But if you were to have, and this is another idea, let's say, males. I don't know about you, Kim, but I run into a lot of males who will say, well, we'll buy one on the wife, but I don't need one, she'll take with me. So his idea is, I'm never going to need it. And if I do, I'm married to it. That's really what they're thinking. And if you look at the statistics on who buys policies, about 80% of people buying policies are married, but twice as many women have policies. So that kind of tells you where the men's mentality is. So again, don't discuss it as insurance for a man. I know our discussion today is around linked benefit policies, and men do like those too because you're at least getting your money back. But you can also discuss a long-term care rider on life insurance and use the rate of return as the selling point. So again, a dedicated stream of income if you need it, and if you don't, we're using a guaranteed product, and here's your rate of return. Your life expectancy is 82. So if you were to pass away at 82, this non-correlated asset in your portfolio will have paid 10%. There is no such thing as a 10% guaranteed return on anything except life insurance right now. So again, you make it about the investment, the portfolio, and you can draw him in. And the long-term care becomes more of, your wife could probably take care of you now. She's 58 years old. But when she's 78 and you're 81, do you really think when she's 78 years old, she'll have the strength to get you in and out of the shower and get you dressed? We want to have a stream of income that can pay for the heavy lifting. She can do the other stuff, but spare her from the heavy lifting. And now men want to take care of their women. And so if you kind of put it into, let's make sure she's not doing physical things she shouldn't do. And here's a little bit of money to pay for it. And if you don't need it, here's a great rate of return. Now for the ultra high net worth, people are probably thinking, well, those are the people we don't need to talk to. Actually, you do, because they have a risk that the rest of us don't have, and that's the cost of getting lucky. And what I mean by that, they're lucky enough to die in their sleep, never needing long-term care. But if that happens, that self-funding that they arranged for, and we're going to imagine in this case, they put $1 million, remember they're going to a nice place, so they put $1 million off to the side in the estate, in a money market fund someplace safe, but it was never touched for long-term care. So what happens? Well, assuming at 2020 tax rates, we're going to have a 40% estate tax. So they're going to owe the estate will have to pay $400,000 in estate tax. That's $400,000 the family is never going to get. Now, if you think about that, there's we see statistics between 52 and 70% chance of needing care. I'm not going to go into which percent is correct. I'm just going to say, let's use the 52% chance of needing care. But that's some care. That doesn't mean you'd go through the whole $1 million if you need it. It just means you'll use some of it. If you go through the whole $1 million, your plan worked out fine. But if you only need care for a year, then probably $750,000 of your money or more is still going to be estate taxed. And then 48% of the people aren't going to need it at all. So how do you protect yourself from paying unnecessary estate taxes because you self-funded? And the way you can do that is with a linked benefit policy owned by an ILIT. And it has to be an indemnity policy. It doesn't have to be cash indemnity, but it has to be indemnity. And what you're going to do is use collateralized arms. I'm going to go through this real quick. So if anybody has a case, we'll have to go in more depth. But we are going to use a loan concept to keep the policy from creating an incidence of ownership. So we're going to borrow, the grantor is going to literally borrow the money from the trust if he needs care. And when he does that, there's going to create a good, better, or best outcome. So the worst case scenario is that in this particular situation, we considered these people wanted $1 million of long-term care coverage. And if they never needed it and self-funded, just put the $1 million aside in the estate, they would have potentially a $400,000 tax liability. So we took a little less than half of that, funded the $1 million. If they never needed long-term care, in this case scenario, $360,000 is paid to the trust, which is distributed tax-free to the children, and we avoided the $400,000 unnecessary estate tax. That's the worst case scenario. The best one is that we went through the whole 6 years. And what we're going to do to get it is borrow money. And we're going to borrow it at 8%. You're probably thinking, why 8%? Interest is so low. Well, you want to use a higher interest rate. So, and you'll see when you see these numbers why it's important. So we're using the guaranteed interest rate of the policy to justify using 8%. Now they're going to collect $15,000 a month in LTC benefits over 6 years. And upon the death, the estate will repay, or the estate's going to repay the principal borrowed to the trust. So we're going to take $1,080,000 out of the estate and move it over to the trust before estate taxes are figured. That can be done with property, cash, stock, anything of fair market value. So that money will get pulled out of the estate. Well, if they had needed care for 6 years, they would have spent that anyway. So one way or the other, that $1,080,000 is out of the estate. But we're going to now also be able to move another $309,000 out of the estate. Now we're going to do that just before the death, but if we do it before death, it's not taxed. So now all of this money is out of the estate. Now the trust has been repaid the principal of $1,080,000. They've also been given an additional $309,000 in the loan interest and the guaranteed death benefit of $72,000. So now the trust is holding over $1.4 million for the kids. Now here's the part that the estate planning attorney really likes. What did this cost? Well, the net cost of the policy, and I say net cost to the beneficiaries essentially is this. Mom paid $182,000 for the policy, but mom saved $123,000 in estate taxes from that 8% loan that allowed us to move $309,000 from the estate into the trust. And the policy paid that guaranteed minimum death benefit, even though we used all the long-term care benefits, there was still $72,000 moved into the trust. The net cost of the $1,080,000 was zero. Now, what estate planning attorney would not want to go present that to a client? And what affluent client wouldn't want to be able to get $1,080,000 of leverage for a zero net cost? That's your best scenario. Now, in reality, it'll be somewhere in between. But the point is, we've avoided paying unnecessary estate tax on putting money in the estate to self-fund, and we've created a leverage at an extremely low cost. Because even if they only go through 4 years, the net cost is still going to be minimal for the $1,080,000. And we've protected them from unnecessary estate taxes.
Yeah, that's powerful. That's powerful. Shawn, do you, like, if somebody had a case and they wanted to see kind of this analysis, I mean, you guys have templates to show this kind of stuff relative to some of the product recommendations that you're making?
We don't do a case by case, plug in the numbers, okay. So, but I can tell someone how to do it. It's really not that hard, but we don't do that, but we can, that's a good idea though. We have a guy, we didn't used to have it. We have a guy now that actually might be able to do it. That's a great idea. So,
there you go. There you go.
Talk to Ryan about making me a template. We'll see what we can do.
Hey, we're getting close to our allotted time, and I have a number of questions, but I want to throw one last thing out, Shawn, and that's really kind of back to Kim. If I could, I don't know if you had other slides and stuff, but if you could just unshare your screen for just a second for me. Kim, you've spent your entire career marketing long-term care as your primary go-to advisory product, right? Now, I know, because I work with you all the time, that you are starting to generate all sorts of opportunities as a result of your lead in. So talk about how you're using long-term care as a marketing tool and what's it doing for your business.
Sure. So first, I would say that more and more people are having experiences with family members where they understand the, the cost of care. And so, often when we're starting the discussion around planning for long-term care, we're getting a full financial and understanding where their assets are, what other insurance products they own, and so on from there. So I had a conversation with a client the other day, and it started about, planning for long-term care. And I asked him, he had some term insurance. And I said, well, what's the purpose of that term insurance? And he said, well, I bought it X number of years ago when I didn't have the estate that I have, and so on from there. And so I said, well, how comfortable do you feel right now that term insurance is going to go away? And he said, well, I don't really need it, and I don't know why I'm, paying this premium. And I said, well, have you really thought about the fact that, we no longer need this death benefit at the first death, but we may have an estate tax. And also, you've talked a lot about, legacy for your kids. And so we're seeing a lot of people who are saying, I'm definitely going to outlive, or it's likely based upon my life expectancy, I'm going to outlive this term insurance. And I should really start looking at maybe it would be a better idea to use this money to buy a second to die life insurance policy, as an example. And that came from beginning a discussion about long-term care. Long-term care has led me to lots of other sales, employee benefits, things for adult children. But sometimes the discussion about planning for long-term care really leads itself to, a linked benefit product, but also it might be a life insurance policy, with a long-term care rider, or a lot of opportunities.
Well, I think what's really meaningful in terms of the way I see your practice, Kim, is that the long-term care process, or the conversation around planning, not for the place but for the event, as Shawn very eloquently stated it. It begins to open up a very intimate conversation around what some of the real goals and objectives are, not just for themselves, but for their family, and what they really care about. And as you are, if you're smart enough to begin to ask follow-up questions about other assets and other things and other goals and objectives that they have, the opportunities are endless. So, I mean, it's a great market to really get in there and start conversations that really matter. We're right at 1 o'clock. In fact, we're a minute over. So I've got a number of questions from the people online, and I'm just going to kind of go through some of these quickly. I've tried to group them into kind of batches. One question: have you compared the benefits of a traditional long-term care policy with a 10-pay option versus an annual or single pay hybrid policy? So traditional long-term care with a 10-pay option versus an annual or single pay hybrid policy. Have you looked at the economics of that, and which one of you would care to jump in on that?
So I would say I've run all of those numbers. And first, one of the things I look at is, who's paying the premium? Are we looking at an employer paying the premium, and recharacterizing compensation? So these premiums could potentially be paid with pre-tax dollars and extinguished over 10 years. And so sometimes that will really dictate the product, because that's what's really most important to them. But then when I look at the ability to have the flexibility, if we're looking at a cash benefit contract, to make decisions in real time and the most flexibility, that might really be what the client's hot button is from there. So every situation is different. And if we're looking for, compensation planning, or favorable tax treatment, and so on from there, then that might lend itself more to a traditional product than a hybrid product. So I'd say with every client, we really look at all of those options before we are making, any determination from that standpoint.
Yeah.
I'll just add,
Please, Shawn, go ahead.
oh, I was just going to add, our Care Matters 2 policy does have the tax advantages. And one of the things in planning premiums will be who's buying it and how they're paying for it and what tax opportunities they have. Because we'll have a pass-through entity where he's better off doing a 10 pay because the tax deduction is what's the attraction to doing this.
Right.
So is he getting a smaller benefit? Yeah, his benefit's going to be a little smaller, but I'd rather sell him something with a smaller benefit and get him to buy something, which he's willing to do if he gets a tax deduction he thinks is attractive.
Right.
So sometimes the tax deduction will be a major decision maker in how we fund the policy.
Correct.
That's great. Thank you. Thank you for that. Another question. Traditional long-term care products and carriers provide dedicated LTC units with specially trained staff who provide tremendous, empathetic, personal support to clients. I think somebody's had an experience here. Do hybrid product carriers have separate LTC units with a similar level of service, or is it just kind of all the same team? And Shawn, I think being from a carrier, maybe you want to hit that one. Did you understand the question?
Sure.
Yeah.
Yeah, I do. So first of all, remember at our company, we're a cash product. We're not going to have a monthly interaction with the client because we're not set up to, which is why they bought our product to begin with. They don't want a monthly interaction. But as far as getting the claim processed, yes, you're going to have that same person. Everybody they all have a lot of experience. They're all very sweet, empathetic, the kindest people who want to give you the most help. They work so hard to make sure that the family is taken care of. So yes, they're going to get that same empathy. In addition, many of the carriers, including Nationwide, we call ours the Nationwide Care Guide Network, but they'll have, care coordination services where you can also get some additional help through that service as well. But yes, we pride ourselves on our wonderful claims people.
And Shawn, I mean, that we didn't talk enough about that. And I think that's when you talk about high net worth or even ultra high net worth clients, sometimes it's not just about the money. It's about the coordination of care, and it's about all the other services that come with these policies. And I think people in this business don't talk enough about that. So thank you for bringing that up. Quick question yes, Kim, go ahead.
One thing you can do is you can use some of the cash benefit for that local, in your home, in your community care coordination as well. And that's what I really like.
Yeah.
Yeah, the care advocate.
Yeah. To what extent is a long-term care cost guaranteed in a linked benefit product and a life insurance product with an LTC rider? So when you have the rider, or let's say on a life policy, is the cost of that rider guaranteed? Like on your GUL policy, for example, Shawn?
So with it, first of all, that question, it depends on a couple of things. One, the base product is going to determine whether the premium is guaranteed. Then second, some companies have a guaranteed cost of the rider and some have a current and guaranteed cost. So let's use a GUL, for example. If you use a GUL, your premium is guaranteed. Now with our company, we have a current and a guaranteed cost. We've been in this business over 20 years. We've never raised the rates. And our actuaries review it every year. And I have been told they cannot foresee that we would ever raise the cost of the rider. But even if we did, it wouldn't matter because we can't raise the premium. If you buy a guaranteed premium product, you are guaranteed. We even have VULs and IULs with guaranteed premiums. And if you buy that guaranteed premium rider, it's all guaranteed. And that's ultimately, that's what the client's looking for. They want to know
Right.
that their price cannot go up. The check they're writing every year or having taken out of their account monthly cannot change. So yes, we can do that. And most companies have some option.
Yeah, that's a great point. And so really the long-term, it's irrelevant whether the rider cost for the long-term care is guaranteed or not, because the premium for the base life policy, for example, in a GUL is in fact guaranteed. So it
All
becomes a
that matters.
non-issue. Got it.
Now with
and
linked benefit policies, it's all guaranteed.
it's all guaranteed.
There is no
Yeah.
such thing as a non-guaranteed link. I don't know of a company who sells a linked benefit policy that's not guaranteed. So you don't have to try to find one that is.
Right.
They all
Yeah.
are.
I'm going to ask one last question because we're now 10 minutes over, and I have no way of knowing if there's a lot of people still waiting online or not. So I'm going to ask this last question because I think it's meaningful. Is a sample document outlining instructions for care available? I think what somebody's looking for here is some guidance as to whether there's something in writing that we can provide, or to advisors, obviously, to provide to their clients to give them some instructions for what kind of care is available.
Well, that's
Kim,
where
do you
we
have
have
anything,
our
or
Care
yeah.
Guide Network. That's where
You're-
we
I'm
use our
sorry.
Care Guide Network.
Right.
Okay, can you elaborate on the Care Guide Network just to give this individual some more information on that?
Yeah, it's a program where you, as a policy owner, you can use it for yourself. You can even use it for other members of your family. So maybe you buy a policy when you're 50, and now when your mother turns 80, she needs help. Even though she doesn't have a policy, you can still use the Care Guide Network to help find. I use an example of a daughter who lives in California. Her mother is in Ohio, and her aunt is still alive, still driving. And mom just says, I don't care where I live as long as my sister can come see me every day. So the first thing, the daughter is like, I don't even know where to start. So she calls the Care Guide Network and say, I want a list of all 4- and 5-star facilities that live within 5 miles of here. And next thing you know, she's got a list, she's on a plane, she's made her appointments. We're all set to go. That's just one small example.
Right.
They also have, they've got these apps now for the family. They can use apps to monitor mom's, the son went over today, and through the app, he can just real quickly update his sisters on how mom was. And I mean, it's an extensive program.
Yeah,
I think
there's some really cool stuff out there. Go ahead, Kim.
AARP publishes 1 million guides about getting organized in the event that you need care. The National Care Planning Council. There is in every state, there is the Department of Aging. So I think there are tons of resources to help yourself identify, what kind of planning. And then some of the care managers, more of them now, are offering what's called a Well Senior program, where you can make a relationship today with a care manager. They can learn everything there is to know about you and your family. They'll check in with you once a year so they know what's changed. But that way, when something does happen, there's already that relationship in place, and they can step in very easily. So I'm a big fan of those.
Yeah, this has been great. Shawn and Kim, thank you for giving us so much wonderful guidance in what's really a very important area, not only for our clients, but in our own businesses. So just a couple quick housekeeping items. First of all, thank you both, Kim and Shawn. This has been terrific. Please remember to fill out your surveys that will be emailed to you sometime this afternoon. Later today at 3 o'clock, please join us for a workshop on Empowered Wealth. We're going to hear from CEO and co-founder of Empowered Wealth, Ron Nakamoto, along with advisor Avi Cantor, who's the founder of the Search Your Group, who, by changing the conversation with his clients to create an empowered wealth mindset, transformed his business and 10x his clients' and his practice. If you want to meaningfully transform your practice, this is a session you will not want to miss. So thank you for your participation on this session. We hope to see you at 3 o'clock. And Shawn and Kim, thank you again for your participation with us today. So have a great day. Thank you.
Everyone.
Take care.
Bye-bye.